Good day, managements, bankers, fixed income investor, and all participants online. I would like to welcome you all to Thai Union Group conference call post TRIS rating revision. Today, the executives who are joining us today are Mr. York Irie, Thai Union Group CFO.
Hello.
Mr. Yongyut Sethathiwat, General Manager, Group Corporate Finance and Tax.
Good afternoon.
And myself, Bas Vayanon, Investor Relation Manager. This event will comprise of approximately 30 minutes of presentation session, and toward the end of the presentation, we'll provide a Q&A session approximately half an hour. Please do note that this conference call session will be conducted in English. For any participant who has any inquiry for our management, please type in the question box on the right and click send. We will raise them during the Q&A session post the presentation. Now, I would like to invite Mr. York Irie, the Thai Union Group CFO, to start the briefing. Thank you very much.
Yeah, thanks, Kun Best. Welcome everybody to this unscheduled and more ad hoc webcast for bondholders. It's one of the first bondholders events that we're holding. We did think it's a good time to make ourselves available, share with you current developments, especially around the recent rating decisions by the Thai rating agency TRIS, and to share with you our thoughts, give you a perspective on where we believe we stand, and what we feel are immediate next steps, and how we feel this affects or not affects our operational decisions and developments. Let me right away start with the TRIS credit rating decision. I think most of you have read this or reviewed it. TRIS has downgraded Thai Union Group from AA-, where we had been for several years, to A+, with a stable outlook. TRIS comments that this, in their view, reflects a weaker financial profile following our acquisition in Red Lobster. They claim it reflects certain unclarity on cash flow creation and debt repayment. TRIS believes that the rating continues to reflect our strong market position as one of the world's largest tuna processors, one of the largest seafood processors, with a large product and market diversity, a large portfolio in leading European and American brands, but with several risk factors that affect us. TRIS also believes that the stable outlook reflects that we maintain our competitive advantage, and TRIS believes that they do not see risk for further downgrades in the next 12 to 18 months unless we do any large debt-funded investments. So, in short, TRIS's decision to revise our credit rating to A+ comes on the back of several quarters of high net debt to equity, net debt to EBITDA ratios. It comes on the back of a period of the last 4 to 6 quarters of operational weakness in our business, with a somewhat depressed EBITDA level, and as a result, our inability to substantially reduce our debt position after the acquisition of Red Lobster. Now, look, TRIS is a very reputable organization. We work very closely with TRIS We have shared our plans. We have had several exchanges with TRIS rating teams, and we absolutely respect their decision. They're a neutral, independent organization, and they follow their own processes and understanding on credit ratings. Now, if you ask me as the CFO of Thai Union, I would probably not see a materially impaired financial stability. I do not see that our financial position is materially weaker than it was 2 years ago or 1 year ago. I think it's clear we went through or are going through some difficult market environment. We had a period of very high tuna prices. We had a period of extremely high Thai baht to US dollar exchange rates. We come off certain events that affected our profitability, and this has led to basically a stable net debt to equity ratio after the acquisition of Red Lobster. Kun Young-Yut will later explain a little bit more our debt structure and how it relates to the Red Lobster deal. For me, and to make a long story short, we do respect TRIS's decision. However, we as Thai Union, we believe in the long-term sustainable earnings contribution of our operational business, the strength of our balance sheet, the strength of the pipeline of very strong strategies to improve earnings, and our ability to respond to market headwinds. And I think we've shown this quarter over quarter. So we believe our financial outlook is in no way worse than it was in the past. We believe fully in our ability to repay debt, to deliver on interest payments, to refund the company, and even more, find further growth opportunities to grow the top line, grow our gross margin, get back to a normalized performance of around 16 to 17% gross margin, and we do have a lot of strategies in place to do this. So this is a starting point. We wanted to share with you a quick reflection on 2Q financials, and I would ask Kun Ludovic, our head of performance controlling and accounting, to give us a quick update.
Thanks, Jörg. So we'll go to slide number 6 in the presentation, where we share the main KPI of our Q2 performance. So the sales amount to 34 billion baht, which is declining by 2% versus last year. We have a huge impact coming from the USD depreciation, and in fact, if we exclude the FX impact, then our sales are almost stable, just declining by 0.1% versus last year. Gross profit, as Jörg said, so we have been facing some challenges into operations. So our gross profit amounts to 13.8 in Q2 18, which is a very strong recovery versus Q1 18, which was at 11.3%. The raw materials were almost stable, mainly the tuna. We have some ups and downs in the shrimp and the salmon business. So overall, compared to Q1, we are recovering. However, compared to last year, we are declining in absolute amount by 5%, but recovering compared to Q1. The OP amounts to 1.1 billion baht. SG&A are under control. They represent 10.4% of the top line, which is basically our target. We recorded in Q2 a one-off. Our subsidiary in the US, Chicken of the Sea, recorded a $44 million accruals related to several litigation. And this is also a very huge impact in our Q2 financials. Net profit amount to 1.4 billion baht. Basically, we have some good news from the FX and from the tax. Plus, we also recorded in Q2 a one-off related to an insurance claim that we have in our Ghanaian factory of close to 140 million baht. So moving to next slide. So you will have the comparison versus last year for 6 months. So total sales are declining by 3.6%, GP declining by 15.1%, OP by 53%. Here you can see that the effect of Q1, which was really declining versus last year, is very strong. And in Q2, even if we improved, we did not recover yet on all of this. I do not comment the net debt to equity. I think Kun Young Yut will comment this one further. Slide number 8. So here we just present our segment view. So we have the ambient world, the frozen and chilled world, and the pet care and value-added world. Here you have the breakdown by sales between the two. So our main segment is ambient with 30 billion baht. And the second one is frozen and chilled with 25 billion baht. And the last one is pet care and value-added with 8.5. We provide also the breakdown between the branded, between channel, branded and private label, but so far we don't have in Q2 some big change in this segmentation. Now moving to slide number 9. So the geographics segmentation, it's roughly the same. US is still our first market. It has been declining since the beginning of the year with the USD depreciation. Europe represents almost 1/3 of our business. And then we have the other, which is 21%, and the domestic market with Thailand, which is 9%. Slide number 10, you have the long-term track record of our gross profits. And here you could see that in Q1 18, it was a record low gross profit that we had, mainly due to the tuna operations, because the tuna fish price dropped. And we had some inventory that we needed to release on this one. In Q2, we are now recovering on this business, and we achieved 13.8. However, still slightly below last year, which was at 14.2%. So on slide number 11, we provide information on the tuna price, which are kind of stabilizing over the quarter, around 1,667 baht versus 1,577 in Q1 18. So you could see at the end of Q4 and Q1 18 the sharp drop of the fish price, which has an impact in our profitability in Q1, because basically we had some inventories of expensive fish price that we needed to process and to sell, and we needed to align our selling price to the spot price. That's why we had in Q1 18 a drop in our profitability. In slide number 12, so we provide with some details regarding the impact of the dollar depreciation versus Thai baht. We already communicated this one after Q1. In Q1, it was close to 500 million baht, the impact. So the impact in Q2 18 was close to 400 million baht. So total over 6 months is close to 900 million baht. So how do we calculate this one? The way we calculate this one, so we know that the USD in average has been depreciated by 7% versus Thai baht. Then we are looking at the Thai baht cost basis that we have in our Thai operations. And 80% of these operations are destinated to the export business. So this is how did we calculate that we have $13.13 million impact, or 400 million Thai baht. And if you compare with our competitors, mainly from Philippines, from Indonesia, we don't have the same change. So basically we were the only one together with China where we had to face with this currency effect, and it was very difficult for us to pass through this inflation to our retailers, to our customers. And that's why we had so many issues with profitability in Q1. And then I will pass the floor to Kun Young Yut to continue with the interest-bearing debt.
Good afternoon, everyone. So we are on the page 13 and 14, right? So I will give you the overview of our loan portfolio and the loan profile we have, right? On the page 13, you can see that by currency, we borrow everything, almost everything in Thai baht, and our maturity is quite long term. We have 3/4 of our portfolio as the long-term financing, and the loan or bond become due in next 3 years is only maybe 1/3 of all of those long-term financing. Whereas 1/4 of our loan is in the short-term basis, which is the working capital requirement that we need to run our operation. And on page 14, you can see on the left-hand side as the source of financing, and almost 100%, as I mentioned, that we borrow from Thai market and in Thai baht currency, and around 55% in fixed interest rate, and around 45% as the floating one, right? But we borrow in Thai baht, and then we on lend to our subsidiary in Europe or in US. In fact, 35% go to Europe and 36% go to US. These two together is 70% of financing that we raise and then we use overseas, right? And only around 30% that we use locally in Thailand. And whenever we borrow in Thai baht and then we on lend in foreign currency, we do the hedging from day one. Just try not to have the FX exposure, and we try to have the fixed interest rate at the portion that we require. And for those one, if you look at the use of fund on the right hand side, the portion of the financing go to Europe and US, and the portion of the fixed rate and floating rate is 56% versus 44%. It means that in the increasing interest environment, we have the limited impact from those increasing costs. And we move to next section. So we are on page 16. On this one, we put the key financial ratio development. You can see that even it's not worse off, but it's not improving also. Even we have a challenging situation, as Kun Yok mentioned earlier, right? So you can see that the debt increased in 2016 from the acquisition of the Red Lobster. That one we fund $525 million to fund the deal. And if you look at the financial ratio, the net debt to equity increased from below 1 to 1.3, and it stay at 1.3 for last 2 years. And for the net debt to EBITDA, actually for the bond covenants or the loan covenant, we have only net debt to equity, right? So the net debt to EBITDA is not our covenants for long-term funding. So the net debt to EBITDA is increased from around 4 to 6 times for over last 2 years, right? And then we put the profitability ratio over last 3 years. You can see that we can generate EBITDA around 10-11 billion over the whole period of last 3 years. The gross profit margin, and that come down a little bit over last 1 or 2 years based on many reasons that we already provide to analysts every quarter. But the net profit, we can keep it stable around at least, we have at least 3%, but in normal case, we should have around 4 to 5%. And from the EBITDA of 11 billion, if we look at the cash that we can generate, right? So we need to add back the depreciation, amortization around 2.75 billion, and then we need to pay the interest every year around 2 billion. And the CAPEX is range between 4 billion plus or minus over last few years. And we should have 6 billion left to pay the dividend or to pay the loan repayment every year, right? And
I think on this page, what I find important is the comparison between our quarterly EBITDA number that's around 2.5-3 billion Thai baht in EBITDA and we have quarterly interest payments in a range of, I don't know, 450 million EBITDA. So we have a factor here of around 6. So our interest coverage, EBITDA interest coverage, is around 5.5 to 6 times. I guess this should give sufficient confidence that there is absolutely no shortage in availability of funds or underlying earnings potential or anything. And this is why we are also of the opinion that our underlying financial performance has not deteriorated compared to 2 years ago.
And now we move to on page 17. So on this one, we just give you transparent comparable between before and after we do the acquisition of the Red Lobster, right? So before, the net debt to equity and net debt to EBITDA on the left-hand side, right? And then we compare with the latest one in June 2018. From the latest one, you can see on the right-hand side, the first one, net debt to equity, right? That one, the debt has increased to 65 billion, right? But you know, on the box that we show, we invest 25% of the common share, which is the US dollar 230, or in Thai baht in equivalent around 8 billion. That one we put into 25% of the common share in Red Lobster. Another portion, we see this as the pass-through investment. It means that we borrow the money from the market, right? And then we put into this investment in 24% of the convertible preferred share in Red Lobster for US dollar 345 or around 12 billion US dollar. On this one, we receive 8% coupon. And if we compare to the cost that we borrow by that time in 2016, by that time the US dollar interest is quite low. We have the effective borrowing in US dollar cost maybe around 3+%. So it means that we keep around almost 5% the interest benefit from this convertible preferred share. And when you look at the ratio that we try to highlight, if we don't count on this pass-through investment, right, the net debt to equity should be around 1.15 instead of 1.4. And if we look at the net debt to EBITDA, it should be 5 times, not the 6 times if we include this investment. So we move to the next page, and it's already happened, right? So what the deleverage plan that we want to put in place. So in here, we put very simple equation of the net debt to EBITDA and net debt to equity, right? We want to bring this ratio down. It means that we need to either bring down the net debt to or increase the EBITDA and equity. So on the upper side, we should reduce the debt by, you know, generating more profit, or reducing or controlling the cash outlay, which we are talking about SG&A, CapEx, interest, tax on those working cap, right? And then we should generate more cash. It could be the divestment or debt restructuring, which we will go into detail later. On the bottom part, we should increase the profit. This one we are talking about we have the strategy to be the excellent at the core business, and we also need to manage the profitable portfolio, which means we need to look more detail and to grow in the profit that we can make profit and divest on non-core or non-profit unit. And we talk about the innovation core plus, which Kun Yok will give more detail, and also the growth initiative that we should put into to expand our portfolio. So I pass this to Kun Yok to walk through on the leverage plan in more detail.
But let us first, thanks Kun Young Yut, let us first jump a page back, slide 17. And what you can see here is our structure, our investment, our debt structure with and without Red Lobster. So if you look at our total net debt of 65 billion, and you then look at the net debt completely without Red Lobster, it's 45 billion. So without Red Lobster, our net debt to equity is below 1. Without Red Lobster, our net debt to EBITDA would be around 4.2, 4.3. Now, if we add in Red Lobster, and I may remind, we've invested $575 million. We have interest costs out of these $575 million of around $15 million, $16 million. And we have interest receipt, dividend receipts from Red Lobster of $28 million, right? So we have a spread that we earn that's already more than $10 million. If we then add the management fee that we get for participating in board meetings of around $2 million, we make here a spread of $12 million that is pure earnings accretive. So in terms of earnings accretion, this is up to now a really great deal, and we intend to keep it that way. If we now exclude the pass-through debt that we have taken up and given it to Red Lobster in a convertible instrument, and we eliminate that from our numbers, our net debt to equity reduces to below 1.2, our net debt to EBITDA to 5.1. And I really want us to look at this and appreciate it, because I think it's something that in the pure methodology of TRIS didn't really fit into the models, and this has led to this decision. It does not mean that our underlying financial performance has deteriorated, at least not in terms of earnings improvement to shareholders. But let's jump further and say, okay, so we're now in this situation. We are encouraged from the capital market, from bondholders, from investors, to drive a more aggressive deleveraging plan. So we looked at 5 elements. One, use financial instruments like securitization of our high-yield convertible units that we own in Red Lobster, or the issuance of a perpetual bond in order to drive down financial equity ratios. It's one option. I'll share with you a little bit later. Asset divestment. There are assets in our portfolio that we believe are no longer required, and we believe we would like to divest them at substantial marketable profits, of course. And you will see over the next couple of quarters several of such decisions to leverage back on assets that we want to divest. Net working capital, efficient inventory management, of course affected by falling raw material prices, but improvement on supply chain finance, accounts receivable, securitization are effective tools that we are implementing, and we will do more of those. Growth initiatives are a main driver to drive our earnings up, recover our earnings, our gross margin, our EBITDA percentage, and we have a lot of those in the pipeline. We've explained before our initiatives in China, the partnership with Alibaba, our growth in Thailand that we're achieving, a joint venture with Thamachat Seafood, the M&A in Russia, our innovation pipeline. So there's a lot in the pipeline that ultimately will lead to earnings improvement over time. And then, of course, last but not least, profitability enhancement, where we look into the profitability of each one of our subsidiaries and drive a very hard cost down initiative, where we say cost discipline is what has helped us last year. It is what will help us this year to substantially reduce our cost outlays that affect our operational performance. And then prudent financial risk management, tax optimization. So I think we have a full array of activities, some of which are managed here in the financial group with our global treasury and financial services headquarter with Kun Young Yut, some of which are managed in each of the operating businesses, and some of which are pure strategic decisions to divest activities and assets that we don't necessarily need to own. But let's go through one by one. Financial instruments, securitization. We have investigated an activity to securitize the $345 million convertible preferred shares in Red Lobster. We have considered using the proceeds of this for down payment. Of course, there are advantages. We were able to release a carry trade from our balance sheet. We eliminate the non-operating debt directly. But of course, we lose some part of the income stream that we get, the 8% dividend yield that we get for this convertible unit. It is a highly complex structure. It is very expensive to refinance this debt, and we have ultimately not come to a structure that for us is financially attractive. We do not want to pay more than 150, 180 basis points above our typical Thai baht bond issuance for such hybrid structures and for such highly complex structured finance. We do want to still have attractive cost of debt on our balance sheet. We've looked into a perpetual bond, and I'm very, very aware that good colleagues of mine in other Thai-listed companies are considering the issuance of perpetual bonds, and so have we. We have been in discussions to look at what is the effect on our credit rating, what is the attraction in the capital market for a Thai union-issued perpetual, and there's interest, there's attraction. But again, it's a question on pricing. Is it 150 basis points above typical bond rates, or is it 250 points above typical bond rates? And I think we need to make good decisions in the end for both bondholders and shareholders to balance here the interests. I think if we find structures that are affordable and attractive, then we are certainly going to consider those, but we will not entertain just financial magic, financial accounting magic, and suddenly all our net debt to EBITDA ratios are better, but in fact we are paying a very high price in terms of cost of funding. So these are some of the considerations that we have on the structured finance. On the net working capital aspect, Kun Ludo has shared with you the tuna price per ton. We look at the gross margin, the gross profit margin that we are earning. So I think the net working capital requirements, of course, are going down if the dollar price per ton is reducing, and at the same time we really want to load up on inventory when prices are low. So it's again a trade-off that we have to take in terms of protecting future earnings against the working capital. And we are working very closely with our operational colleagues to find the right balance in decision making on when to buy and when to fill the inventories, and when to go easy and release cash to from the balance sheet. Growth initiative, one of our real focus areas is China. We've signed an MOU with the Alibaba Group. We met and are collaborating with the super fresh goods operator Iguo in China. We work with others to drive our King Oscar brand. So China is a real growth market, and you will hear more from us on the entrance into China and growing our business there. Together with Alibaba, together with HEMA, and our commercial partners in this huge market. But at the same time, we want to do this in a very conscious, risk-conscious way. We do not want to go out and grow for the sake of growing. We do want to do this in a sustainable way where we also can earn margins and positive profit contributions. Thailand is our home market, and our growth in Thailand is extremely strong. We have just acquired a minority stake in Thamachat Seafood. We are contemplating to expand this share in the next 12 months if we have good experiences. And Thamachat Seafood operates around 158 locations in the frozen and chilled seafood space. It provides premium imported and local fresh and frozen and smoked seafood. We operate food and beverage concepts in 8 locations, and we are actively thinking about bringing some of these brands even in neighboring markets, or potentially into China, and leverage on the good brand image we have here in Thailand, and expand not only in retail but also F&B potentially in the Chinese market. Other growth initiatives around Thamachat is, of course, the frozen segment. Thamachat is very strong in the chilled market, in food and beverage, and operating the chilled segment, fresh and chilled. And together with us, we believe growth in the frozen shelf is possible. The frozen shelf in many retailers is pretty disorganized, and we believe that adding good category management and high quality seafood from Thai Union into the frozen shelf in the large retailers is something consumers will value, and that's the key deal rationale for us, together with Thamachat here in Thailand. Another acquisition that we've done, it somehow doesn't show very well on the chart. The text is somehow missing, it seems. So let me explain a little bit about our Russian investment. We have invested in a company called Maguro Dal Promryba in Russia, 45%. It's the #1 canned tuna processor in the market, has around $45 million in revenue. It has large own brands, well-known brands, and our intention is to increase our shareholding above 50% and maybe up to 80% once we have a good experience on this. Key driver here is a strong growth momentum in the ambient seafood market in Russia. Innovation. We've started with launching a very specific innovation initiative around what we call a fridge pot. We're moving out of the can and we move into a salad pot that is resealable, with which we can move typically from the storage cabinet and the upper shelf of the storage cabinet directly into the fridge. With this, we can drive consumption. It is easier to open and consume tuna for dinner or at lunch occasions. It's no longer required to open a can and then eat the whole tuna. You can eat half of it and reseal it and close the fridge pot. A new innovation that's on the shelf in the UK now, and we see a lot of interest from customers and consumers. In the US, we launched our Chicken of the Sea Infusions, which is a product that is a no-drain product, flavored tuna in 4 different flavors, more spicy ones, more Mediterranean ones, more with basil, more with lemon. A very nice product to consume, ready to eat, and very attractive in a small little pot. There's a fork included, and it's very easy to consume and brings the tuna that is historically in a can, it brings it into a new form factor and a new interest for people to consume. We have a couple of more examples. I don't want to go too detailed. I just browsed through the next couple of slides. Tuna pasteurization in the chilled shelf in France, in Petit Navire, great innovation. Marine ingredients, we are in the final steps of commissioning our refinery in Germany. This is a picture of Rostock, where the upper 2 pictures where we've built the refinery. And the lower picture is in Samut-Sakon, an oil extraction facility, absolute state-of-the-art facility, both that will drive our marine ingredients, our tuna oil business. And we are in the process of preparing the first trial productions. Our yellowfin tuna slices, we've presented those already for the last couple of quarters. Good initiative, very high interest from consumers. Again, a new form factor, again, a new way to consume tuna. And that's our key interest. Bring new and innovative ideas to our raw material, make it attractive for clients and customers and consumers to eat tuna in an easy, non-messy, non-smelly, and in a healthy way. And last but not least, some innovation around automation. We increase our level of automation quarter by quarter. We have deskinning machines, we have deboning machines. Our focus is here really on improving cost efficiency, labor efficiency, improving quality even further, and becoming an image of Thailand Industry 4.0, also here in the seafood space. And with this, I guess we are reaching the end of the presentation session, and we want to move to the Q&A.
And that's sum up for the presentation. Now I would like to open for Q&A session for any inquiry that you may have. For any participation who have any inquiry or question, please type in the question box on the right of the screen and click send. We are currently have a number of questions coming in from the participant from the early inquiries earlier, so we will try to respond them as they come by in. Thank you very much.
Okay, I take the first question. How is operation recovery tracking? Should we continue to see further improvement in the second year of 2018? I guess you're all aware we are a bit careful with forward-looking statements. We typically make our performance reviews in our earnings release. But what I can tell you is I think fish price is more stable. We've addressed some of the issues. The price recoveries that we've done in some of the markets are successful, and I think you can see in the second half here some improvement going forward. So I think we really want to address here operational improvement, and I think you should see some of this in the second half year. When is innovation going to be a factor in improving profitability? I think we already see today that for those programs that we're rolling out, they have a very strong margin effect. However, as you rightly point out, the volume is not very huge yet, so we need to see for a lot of these innovations to come to scale. But I think you will see a much stronger development in terms of innovation and the impact on the mix factor on our P&L over the next 3 to 4 quarters. So I think in a year from now, we will talk about real contribution from innovation. What is the debt ratio target, how the company plans to achieve it? I think we have been firm on our debt to equity, net debt to equity ratio of between 1 and 1.1. That's a range where we feel comfortable, 1 to 1.1 net debt to equity. I think I've mentioned a couple of action steps, sale of certain non-core assets, improvement of gross margin and EBITDA levels, and further actions on the balance sheet with structured finance and activities that can help us to reduce our debt level. So these are a couple of items. I'm actually quite comfortable to say we have a lot of these well under control, so I don't feel that there is a real danger of not achieving these targets in the next 18 months.
So on the credit rating, the question be on when will be the next assessment. Normally we have the annual review every June or July, you know. So maybe next assessment will be next year from now. And then the question whether TRIS warned you about the rating downgrade in advance. Actually, we did the same. I mean, we provide the information and our thinking and our plan, or those deleverage plan and how we improve the profitability to TRIS. We don't receive any pre-warning from the TRIS, and in general we need to wait until they make decision, so that we don't know in advance on the decision from the TRIS. And the question what the current bond covenants we have, actually we have 2 covenants. The first one is net debt to equity, which is the covenant is at 2, and current ratio that we have is around 1.35 up to 1.4, so still more headroom. But you know, as Kun Yok mentioned, our target is 1.0 to 1.1, so we want to bring it down instead of, you know, let them move up, right? And then another covenant is on the interest coverage ratio, which is the EBITDA divided by the interest payment. The covenant is at 3, and currently we are at 5, so we still have the headroom on that one also. So that is that are only 2 covenants we have with the bond investment, bond issuance, or the long-term loan financing. And what the impact from this rating downgrade to our funding costs? In fact, as I mentioned, that around 60% of our financing is in the fixed interest, and only 1/3 that we are on the floating basis, and all of those is more on the working cap. So currently we don't see any increase in the borrowing cost. That one will be the short-term impact. But next year we will have the 9 billion Thai baht of the bond due become due. So on that one, we already discussed internally and look for alternative that we can have. We can go back to the bond market, issue the new one with the new credit rating, or we just simply go back to the bank and looking for the Thai baht syndication. And we also look at the other market also, just for example, the Japanese samurai syndication loan, whether the pricing is attractive. And we may use this opportunity to diverse our source of financing. And
couple of other questions. Quick question on Indonesia. I think we observe the situation in Indonesia, of course, very, very carefully. We've decided to set up a business in Indonesia on shrimp feed. The key focus here is, of course, a domestic operation for the domestic market in Indonesia. So I don't think import tariffs are affecting us here much, nor currency, because it will be a domestic operation. For our normal trade business, Indonesia is not a major export market. So we go to Indonesia because it's an attractive market for feed, and it will be local for local. A couple of questions on M&A. Will a high level of debt have an impact on CapEx or M&A? Look, you've heard us already for a couple of quarters, our prudence on M&A. We have not done any large transaction for quite some time, and I don't think you should expect us to make any big acquisitions in the near term before we have here a much better net debt to equity ratio. And that is totally regardless of the credit rating or any other considerations. This is just a function out of our own investment initiative. We have invested in the Red Lobster. We have invested into Russia. We've invested into Thamachat. We may still continue to do some small acquisitions and deals, but anything large, I think we first need to normalize our net debt to equity level back to 1 to 1.1. So focus is on integration and synergy creation. Would we consider reducing our dividend payout ratio? I think we are very confident on our dividend payout ratio. We're very confident in our earnings potential. We have a clear policy to pay more than 50% of our net income to shareholders, and we intend to stay firm on that. We believe in the strength of our earnings, and we want to have our shareholders participate in the earnings development of Thai Union. Question on Red Lobster. Look, the question here is, how is Red Lobster doing? Should TU increase its stake? Will TU raise debt or equity to fund such a deal? We went out on the deal with 3 key parameters. 1, increase of our revenue with Red Lobster. We wanted to sell more seafood. This is on a good track. We increase slightly year over year. Maybe not as quick as we wanted, but there's a good and solid business, and the added value business is increasing. So I think there's a good tick mark. Second was international expansion. We will bring Red Lobster to China. We will see further growth of Red Lobster in the international markets. So I think we have some indication that there could be interest and further growth. But I guess the key topic is operational improvement. We bought the business at 5.5 times EBITDA, 5.5% EBITDA on revenue. We said we need to have the business come back to 7-8% EBITDA before we invest more. We have not improved the EBITDA levels to the level where we wanted it to be. So at this stage, I think we need to really first work harder with Red Lobster to get the operations improved, get back to growth, get guest counts up, become more relevant for younger consumers, and bring EBITDA levels back to $160, $170 million level before we make here decisions on increasing our stake. That's why we have this structure that we've chosen, where we will only invest more if there is a good business case and value creation for our shareholders. Last question here, at least on my list. U.S. lawsuit. Look, we've accrued $42.5 million in Q2 to provide us with the funds required to solve this case in the US. We believe this is a good estimate. We believe this is a good number. And now we're focusing on settling these topics over the next couple of quarters and years. This is not an easy topic. This is not over in the next a couple of months. This will still take at least 2 years to be resolved. We believe 44 million is sufficient. So let's see how this goes over the next couple of quarters, and we'll update you regularly. So we do not see that there is any further impact on cash flow. Well, strictly speaking, on cash flow, yes, but not on earnings. The 44 million was an accrual. Only part of it was cash relevant. So the cash effect out of the accrual is still coming in the future, but we believe it will be contained at $44 million.
And the question on the FX management, what are the typical FX impacts on your balance sheet? On this one, we make it very clear that we look at the FX risk as into two activity, right? The first one is FX risk come from financing, investing activity. On that one, we have very clear policy that we need to close is 100% risk that we have. It means that whenever we borrow in one currency and we on lend into other currency, from day one, we need to hedge on the FX 100%, and we will not let the FX gain loss to impact to the cost of the borrowing, right? And on this one, we also consider carefully on the debt and equity ratio that we need to put into the subsidy when we need to fund those or send the funding requirement to our subsidy overseas. So in general, we will put as much as debt into those injection and leave as less as equity, so that we can, do the hedging easily on the intercompany loan, and also we can do the cash repatriation. It means that we can bring back the cash left at the overseas subsidy through the interest or the debt repayment, and also to when we receive the cash back here in Thailand, we can pay down the debt that we have in Thailand, right? And another activity that we look separately from the financing is the trading activity, when the exposure come from the exporting and importing activity. On this one, we have very clear policy that whenever we see the risk of those FX position, at least by half, we ask our subsidiary everywhere around the world to hedge by half from when they see the risks. And another part, another 50%, we look at the trend of the FX movement, and then we try to hedge gradually after we hedge the first half already. So in terms of policy, we have really clear guideline to our treasury team overseas to follow.
Okay. I guess now we have finished up the list of questions, and this concludes the live webcast session for Thai Union Group conference call post TRIS rating revision. Thank you very much for your time and interest in participating in the session today. I would like to give thanks to our executive joining us today, Kun Yok Ari, Thai Union Group CFO, Kun Yong Yusetatiwat, and Kun Ludovic. If you have any further inquiry, please feel free to contact IR department at any time during office hours. I wish you have a good day and thank you very much.
Thanks a lot, everyone, for joining. We will keep you updated on any developments. I think this format of having webcasts, I guess, turns out to be quite a good and quick communication tool. We stand for transparency. We stand for immediate communication. And any of you who has questions, inquiries, please contact the IR department, send us an email, contact me directly. We feel it's extremely important to have good communication, transparent communication with our bondholders, with our shareholders, and with the capital market. Thanks a lot for joining today's call.
Thanks a lot. Have a good day.
Thank you for the bankers as well.
สวัสดีครับ